My name is Pat O'Connor, and this is video number 26 in my mortgage exam tutorial series. It's the last one. It's been 6 months, and now I've got them all. So today I'll be finishing up ethics. Information in these tutorials comes primarily from the study guide that I have published on Amazon. It has hundreds of questions and answers and 2 practice exams, and it's updated every year. There will also be a quiz available. I'm not sure. All the other quizzes had 10 questions. I'm not sure this video's gonna warrant 10 questions. It's all pretty straightforward, but I'll try. Anyway, the directions on how to request the download link for the quiz, it is for subscribers, and it will be at the end of the video. Now, the third thing, and I referenced it in last week's video, is that I am going to turn this into a video blog. So I will keep on producing videos, and I will be talking about changes in the mortgage industries as well as new job postings. I will try to do it every Wednesday. So in case I get off schedule a little bit, I think you should probably subscribe, particularly for job postings. I will do them around the country. A lot of you can get licensed in multiple states. So, if it's not in your home state, then maybe there's good opportunities opening up somewhere else. And you could take that, apply for that state's license as well as your home state. All right, let's get started. This isn't very complicated today. Previous videos have covered a lot of the information that they put in the ethics section. So in the book that I have published on Amazon, I do have links to Q&As for some of these that you might want to refer to if you did poorly on the ethics section on the national exam. So I will go through these, but again, this isn't going to be too long or too in-depth. My advice to you is to think of the golden rule. Would you want someone to do that to you? If the answer is no, it may very well be unethical. It may not be illegal. The outline on the MLS kind of implies that those words are synonymous. They're not. You can do a lot of things that might be unethical, but not illegal. All right, enough chit chat. Let's get started on this last video. If I had a bottle of champagne, I would pop it, but I don't. Okay, ethical issues, advertising. You can't mislead. The terms have to be what you can offer to at least a substantial amount of people. I mean, TILA says you can't have this bait and switch where you offer something and then you only have one of those available, right? If you're making an offer, then it has to apply to enough people to satisfy federal laws, and I'm not exactly sure where that cutoff is. But no bait and switching. No unfair, deceptive, or abusive practices. And abusive could mean that someone is intellectually challenged, although they still have the legal authority to sign contracts. Perhaps they're getting older and the mental facilities are not what they should be. You go ahead and have them sign, mortgage applications for refinance or something like that that may not necessarily be to your advantage. What I would recommend, and as a real estate broker as well, if you suspect that someone is not in their right sound mind to sign contracts, I think you should protect yourself as well as them by asking them for the name of a family member. It's the right thing to do, and if you don't, it might come back and bite you. Because one of the state laws, they have to be of sound mind to say to sign things, and if they're committed somewhere, or if they have a doctor's diagnosis of dementia a week after they sign something to get some huge loan, you may be on the hook. So be careful. Don't deceive. Don't abuse. And elderly abuse is a big thing. Follow the TILA regulations that we covered almost 6 months ago. Truth in advertising type of things. Again, if you disclose one financial term of an ad, like no money down, 0 money down, you have to disclose the APR in the rest of the terms. So you can review the TILA video if you have forgotten some of those kind of things. If I remember, I'll have that as one of the links at the end of this video, back to the TILA video. Predatory lending and steering, churning. Again, some people think because you are their neighbor or a relative that you wouldn't do them bad, and that's not the case. People trust people they shouldn't trust. And churning is where you go back and you continually refinance, even though it has no significant benefit to them, but you're getting paid for it. And it's against the law. You can't do that. Predatory lending is illegal. High cost loans, HEPA can come into effect on those. Again, that's another TILA. Financial responsibilities, permitted fees. This is covered. MLO compensation is covered in the SAFE Act, the Loan Originator Compensation Act. You can't receive payment from two sources. Like the borrower and the lender can't both pay you on the closing statement. Fee changes. If you incorrectly put your commission, like the loan origination fees, and it's low on the loan estimate, too bad, you're stuck with it. That's not one of the legitimate reasons for changing the loan estimate. Referral fees, loan originators cannot receive referral fees. Commercial real estate mortgage brokers can, because they're not regulated under these laws. So commercial's a whole nother ball game. They can get referral fees. They can split, fees up the wazoo. They don't have to follow most of these federal guidelines. Commercial buyers have the assumption of being more sophisticated and needing less protection than residential buyers. Commercial buyers are most likely represented by an attorney. And if your state doesn't require a residential real estate lawyer to represent the parties, then they may not have him. Here in Florida, it's pretty much, they depend on their realtor to explain everything to them. Once in a blue moon, someone will have an attorney. Okay. Fee splitting. I meant to look this up and then I got distracted because it was the last one. There is something in one of the laws that there is, it may be RESPA, that there is a certain number of duties that a loan originator can accomplish. And it may be, I think it may be something like 13 different duties. And so if you are splitting a commission, each of you has to be able to prove that you completed, I think, 5 out of those 13. So it could be possible for 2 people to split the commission, but really, I think impossible for 3 people because 3 in doesn't go into the math doesn't work. If you have 13 unique responsibilities, if you have 3 people that can't each do the 5 that required. So it's something all along those lines. Once you get hired, you could ask your manager if it ever comes up to that. Maybe you're going on vacation and you have some transactions in the works and somebody's going to split the commission with you, talk to the manager. Handling borrower complaints. Again, think, how would you want to be treated if it comes to a multiple choice question and there's some answer that makes you cringe and the rest of the 3 sound like they're okay? Pick the one that makes you cringe. Like, oh man, don't treat me that way. All right, again, confidential. There's some chit chat that loan originators may in fact have a fiduciary responsibility to the borrowers. You will hear this every now and again start circulating around. It would be like a CPA responsibility where they can never ever divulge anything confidential about you to anyone for the rest of your life. So that there's talk that this is what the loan originator relationship with a borrower actually is, but it's not legally written out that way. But stay tuned. It could be that that's coming in the future where you would have a fiduciary responsibility, the same as a doctor, patient, attorney, client, that kind of thing. So watch out for it if it happens. Mortgage company compliance. I briefly mentioned this in one of the previous videos. Say that your borrower tells you, you're doing a follow-up call and the borrower tells you they just got fired. All right? So you know it as a loan originator. You're obligated to tell your manager. Your manager is obligated to tell the lender because it now affects the qualifying process. They've had a dramatic change in their, pre-qualification, pre-approval. They have now lost the income. How dramatic? It will depend. Do they have a spouse that's working? Do they have millions of dollars in savings? All this can come into play. But once you know something that affects their financial, anything to do with their qualifying credentials, you have to let people know. Or again, it can come back and bite you afterwards. Information supplied by employers. Well, no, they don't work for us anymore. And all this approval is after the fact. You're going through, you're running along, everything's going really smoothly, and then the loan processor comes back and says, well, no, got hold of their employer and they never heard of this guy. Could be that there is a name mismatch. Like my legal name is Mary Patricia, but you might call some places and ask for Mary O'Connor and they'll say, I don't know who she is. So it could be something like that where they go by their middle name. It doesn't necessarily mean it's going to be a disqualification, but if something comes up and it's verified that there's been a change in the situation, the lender has to know. Relationships with your consumers, with your borrowers. Keep it confidential. Don't go blabbing about somebody's upcoming divorce because they told you, and it's going to affect their financial situation, and da 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 da. Disclose conflicts of interest. Maybe you were looking at buying that house. The borrowers, got the money, or something. Maybe a relative of yours is the seller. Maybe your company's part of the listing agent's real estate company, right? Those are the disclosure that you have to give right away. If you have like one of those umbrella things where you have like a real estate company and a mortgage company and maybe a title company. So that disclosure is probably already there, but it could be like, hey, maybe the seller is using our real estate company. That kind of stuff should be disclosed. Falsified information by borrower or the mortgage loan originator. Again, your manager should be overseeing this, should take corrective action, either kick your rear end out the door or have a nice little chat with you about rules and regulations that you have to follow. Giving solicited advice or unsolicited advice. Well, I think you should take, a 15-year ARM instead of a 30-year ARM because you're 80 years old. That would be unsolicited, and their monthly payments are going to be higher. Don't do it. Again, treat the elderly the way you would your sister. Don't just assume everybody's a target. As I get older, it gets more personal. So treat the old folks nicely, and you'll get rewarded. Don't disclose anything about your parties to outsiders. Realtor may call you and say, the selling agent's realtor may call you and say, what's the situation? Make sure that you can disclose that. They should really be talking to the buyer's agent, not directly to you. But sometimes lines get crossed, sometimes people are uncommunicative, but be careful about that. Okay, so I put in my 2 cents worth for the elderly. All right, if you want the quiz, directions are up here, instructions are up here. I hope this has helped some of you to pass the national exam. And stay tuned, subscribers. You don't want to miss the future video blogs. All right, I will see you in the video blog world. Thanks. Bye.